This episode is supported by AnalystKit.com. Thousands of tried-and-true calculations mixed with AI to find you the best stocks in a single click.
Imagine parking like $50,000 of your hard-earned cash in what you thought was just a bulletproof, perfectly safe financial product.
Right. You think it's completely locked down.
Exactly. You go to sleep, the financial market's panning overnight, and you wake up to find out your account wasn't actually a bank account, it wasn't federally insured, and a chunk of your principal is just gone.
Which is terrifying.
It is. And the craziest part, this happens simply because people misread a single word in the name of the product.
Yeah, the financial industry relies heavily on that kind of naming fatigue.
Yeah.
They know consumers see familiar words grouped together and instantly let their guard down.
Oh, absolutely.
They just assume a level of safety that, legally speaking, just does not exist.
Welcome to this deep dive. Today, we are taking a highly practical, fairly aggressive look at a source text designed to help you evaluate money market products.
It's so needed right now.
It really is. If you've got cash sitting around, whether it's an emergency fund, a down payment, or just money waiting to be deployed, and you want to maximize its return without falling into the traps hidden in the fine print, you are in the right place.
We're basically looking past the marketing banners today.
Right. Digging into the actual mechanics of how these cash vehicles operate.
Because the cash management landscape has, it's fundamentally changed. We aren't in a zero interest rate environment anymore.
Thankfully.
Yeah, thankfully. Which means optimizing where your cash sits actually moves the needle on your net worth. But the moment you try to capture that yield, you are navigating this minefield of highly specific terminology and backdoor fees.
Okay, let's unpack this. Because before we get to the yield, our source text insists on a crucial first maneuver.
The foundational step, yeah.
Right. You don't start by looking at interest rates. You start by defining the purpose of the money itself. It's almost like writing a highly specific job description for your cash.
I love that analogy. And if you apply that framework, you immediately realize why so many people end up in the wrong financial product.
How so?
Well, the job description for this specific type of cash is really rigid. The candidate must provide liquidity, it must provide absolute principal safety, and it must offer some yield to offset inflation.
But not too much yield.
Yeah. Exactly. It is explicitly not hired for long-term growth.
Right. Like, I'm not hiring a money market product to fund my retirement in 30 years.
No, definitely not.
I'm hiring it to ensure I can pay cash for a new transmission if my car blows up next Tuesday.
Exactly.
But because the core requirement of this job is absolute safety, we have to talk about the trap I mentioned at the top of the show. We are looking for a money market account, but the industry routinely pushes people toward a money market fund.
Yeah, and what's fascinating here is the massive structural difference hiding behind one word.
One single word.
Right. A money market account is a standard deposit account at a bank or credit union. You are lending your money to the bank, and they owe it back to you. But a money market fund is a mutual fund. It's an investment vehicle offered by brokerages.
Wait, so when I put money into a fund, I'm not making a deposit.
No.
I'm actively buying shares in a portfolio of assets.
Exactly the distinction. These funds take your cash and they buy short-term debt. Things like commercial paper, which is essentially short-term corporate debt, or municipal securities.
Okay, but they look like bank accounts, right?
Right, because these funds are engineered to maintain a stable share price of exactly $1. They want you to feel like you are just looking at a normal bank balance.
But the SEC, the Securities and Exchange Commission, issues a glaring warning about these funds.
Yeah, they do.
Because if they are holding corporate debt, what happens if the corporations issuing that debt suddenly default?
Yeah, that is the nightmare scenario. It's known in the industry as breaking the buck.
Breaking the buck.
Right. If the underlying assets in that portfolio lose value, or if there's a massive liquidity panic where everyone tries to withdraw their cash at the exact same time, like we saw in 2008, the fund cannot maintain that $1 share price.
Wow.
It drops to 99 cents or 97 cents. The illusion shatters, and you realize you just lost a percentage of the money you thought was completely immune to market volatility.
Which means if your job description for that money demanded absolute, unquestionable safety, you just hired an investment product masquerading as a savings vehicle.
You hired the wrong candidate.
Totally. So if we know we need to seek out the deposit account and avoid the mutual fund for this specific pool of cash, we have to verify the safety net under that deposit account.
Right. You're looking for the federal backstop.
The insurance.
Exactly. If you were dealing with a traditional bank, you need to verify FDIC coverage. If you're using a credit union, you need to verify NCUA coverage.
Let's clarify that for a second, because we hear FDIC all the time, but NCUA gets a lot less airtime. That's the National Credit Union Administration, right?
Correct. And it functions identically to the FDIC, but specifically for credit unions. It is backed by the full faith and credit of the United States government.
Okay, good to know.
Yeah, if the credit union goes under, the NCUA ensure you get your deposits back.
But I'm going to push back on how easy this is to spot, because our source emphasizes not making assumptions.
You really can't make assumptions.
Wait, so if I just see the words money market, I shouldn't just assume it's covered, even if I'm on a major bank's website and they're advertising a high-yield money market account. Doesn't the sheer fact that it's offered by a bank imply it's covered by the FDIC?
No, you absolutely cannot rely on implications. Seriously. The Consumer Financial Protection Bureau explicitly advises consumers to look for the official FDIC or NCUA designation on that specific product.
And it's a bank.
I know, but banks sometimes partner with third-party brokerages to offer yield products on their own platforms.
Oh, wow.
Yeah, you might think you're opening a bank account, but you are actually being routed into a brokerage sweep account or an uninsured fund. You have to verify the insurance limit, which is currently $250,000 per depositor, per institution, per ownership category.
And that limit introduces a huge blind spot for anyone managing larger pools of cash.
It's a massive trap.
Let's say I have a checking account with $100,000 and a traditional savings account with $100,000 at the same bank.
Okay.
And I decide to open a brand new money market account there with another $100,000 just to capture a new promotional yield.
You've just created a massive vulnerability.
Really?
Yeah, because that $250,000 limit applies to your combined balances in individual accounts at that single institution.
Ah, I see.
In your scenario, you have $300,000 sitting there. If that bank experiences a run and goes into receivership, $50,000 of your money is completely uninsured.
So I chased a 4% yield and ended up risking $50,000 of my actual principal.
And this happens constantly. People consolidate their finances for convenience. They want one login without tracking their aggregate exposure at a single institution.
Right.
You have to monitor your deposits holistically or spread them across different banks or, utilize different ownership categories like joint accounts, which carry their own separate insurance limits.
Okay, so we've isolated the right product and we've mathematically guaranteed the insurance coverage. Now we can finally talk about the actual yield.
The fun part.
Right. And here's where it gets really interesting, because the moment you try to compare rates, the industry throws an alphabet soup of acronyms at you, primarily the battle between APY and APR.
Yeah, the CFPB's Truth in Savings rules require strict distinctions here, but marketing materials often blow the lines if you aren't paying attention.
Because of course they do.
Of course. So APY is your annual percentage yield. This is the metric that factors in compounding frequency, how often your interest earns its own interest over the course of a year.
To bypass the technical jargon, I always use a simple analogy about who is doing the eating.
I like this one.
APY is what the bank feeds you. It's the metric that measures how fast your pile of cash is growing. APR, the annual percentage rate, is what the bank eats from you when you owe them money, gobbling up your capital through interest and loan fees.
That's a great way to put it. For any savings vehicle, you are the lender. You are lending your liquidity to the bank to use for their own lending operations.
Right, so I want to be fed.
Exactly. You want to be fed.
Right.
So APY is the singular metric you care about.
Okay, perfect. So I scan the market, I find the highest ATY, I verify the insurance, and I'm done.
If only it were that straightforward.
Why isn't it?
You have to navigate the balance tiers. Banks are incredibly strategic about how they calculate interest against your balance.
This is the part of the source material that genuinely frustrates me.
It's infuriating.
So that giant percentage rate they advertise in the window might not even apply to my actual balance?
In many cases, no. Often, you're getting dropped into a lower tier, earning a fraction of a percent. The headline rate was essentially clickbait for retail depositors.
So they lure me in with a giant banner ad promising a 5% APY, but when I read the disclosures, I realize that rate only applies if I park $250,000 in the account.
Exactly.
If I just want to drop in my $20,000 emergency fund, what am I actually getting?
Peanuts, usually.
Yeah.
Alternatively, banks will use an inverse tier structure to acquire new customers cheaply.
How does that work?
They will advertise a massive 6% APY, but the fine print reveals it only applies to the first $1,000.
So the first 1,000 earns 6%, and the remaining 19,000 of my emergency fund earns basically zero.
Exactly. Your blended yield ends up being terrible. And then there is the promotional cliff.
The bait and switch.
Basically, they offer a fantastic APY that is guaranteed for the first 90 days. You go through the friction of opening the account, linking your external banks, transferring the funds, and on day 91, the rate silently drops to the basement.
Just hoping you don't notice.
Right. They are betting on your inertia. They know that once the money is there, you likely won't bother to move it again for a 1% difference.
And even if you do manage to hit the exact required balance tier to get that optimized yield, the banks still have backdoor ways to claw that interest right back out of your pocket.
Oh, yeah. The mechanics of the account can easily destroy the yield.
The fees.
The fees.
Yeah.
A $15 monthly maintenance fee doesn't sound like much, but if your balance is only generating $20 a month in interest, the bank is quietly confiscating 75% of your return.
Or excessive transaction fees. If this is an emergency fund, and I actually have a series of emergencies, like a medical bill, a car repair, a flight I have to book last minute, and I have to pull money out 4 or 5 times in a month, I get hit with fees for utilizing my own money.
It's totally counterproductive.
Which brings up the core conflict of these accounts. Access. Yield means nothing if the liquidity isn't there when the crisis hits.
Yeah, if we connect this to the bigger picture, the source outlines a fundamental trade-off that every depositor has to weigh: yield versus liquidity.
Right.
You have to evaluate the transfer mechanics. Can you write checks directly against this balance? Does it come with an ATM network?
Or is it totally locked down online?
Right. And if you have to initiate an ACH transfer to your primary checking account, does it take 1 business day or 5 business days to clear?
I mean, if I have a contractor standing in my flooded basement demanding payment to start the mitigation, a 5-day clearing window is useless to me.
Absolutely useless.
It makes me think that if the bank is going to put me through this much trouble, navigating tiers, dodging maintenance fees, dealing with slow transfer windows, I'd almost rather just lock the money up in a certificate of deposit or buy a treasury bill, even if it means voluntarily giving up some liquidity.
That is a highly strategic pivot, and the source encourages looking at those exact alternatives.
Oh, really?
Yeah. If your money has a specific time horizon, say, you don't need this cash for exactly 6 months because it's earmarked for a tax payment, a certificate of deposit or a CD allows you to lock in a fixed rate.
Okay.
You trade away immediate access in exchange for rate certainty.
And you mentioned treasury bills.
Right.
We should define what those are because they operate in a completely different ecosystem than bank accounts.
They do. Treasury bills, or T-bills, are short-term debt obligations backed by the U.S. Treasury. You're lending money directly to the federal government for a period of anywhere from 4 weeks to a year.
And they aren't FDIC insured.
Right. They don't carry FDIC insurance because they are backed by the government itself. It's the ultimate backstop.
Which introduces the final and arguably most important hurdle in our source text before making a decision. You cannot compare the yield of a bank account to the yield of a T-bill without doing the tax math.
No, you can't. And this raises an important question for anyone optimizing cash. You must calculate the after-tax yield, often called the tax equivalent yield.
Break that down for us.
Sure. The interest you earn from a money market bank account is generally fully taxable at the federal, state, and local levels.
But the interest from a treasury bill is treated differently.
It is. T-bill interest is subject to federal income tax, but it is exempt from state and local income taxes.
That's huge.
It is huge. And the math gets even more complicated if you look at municipal money market funds, which can sometimes be exempt from federal taxes too.
Okay, let's walk through the reality of that. If I live in a state with a massive income tax burden, say California or New York,
Right.
and I'm sitting in a high tax bracket, a standard bank account offering a 5% APY is going to get heavily taxed.
Very heavily.
So a treasury bill offering a slightly lower advertised rate, maybe 4.5%, might actually put more real spendable dollars in my pocket at the end of the year because California isn't taking a cut of the T-bill.
That is the exact analysis required. If you are financially literate enough to be chasing yield, you must be calculating the net return after taxes and after fees.
It's all about the net.
Exactly. A higher growth APY is completely irrelevant if the net return is lower.
So what does this all mean when we look at this entire roadmap for parking cash? How do we synthesize the source text into an actual strategy?
The conclusion is that cash optimization requires active defense.
Active defense. I like that.
Yeah. Do not blindly chase the highest advertised percentage rate. First, confirm the structural type of the product. Ensure it is a deposit account and not an investment fund if you require absolute principal protection.
No breaking the buck.
Exactly. Second, verify the federal insurance limits against your aggregate exposure at that institution.
Watch out for that $250,000 limit.
Right. Finally, ruthlessly calculate the real after-tax yield, factoring in balance tiers, maintenance fees, and your actual liquidity needs based on the job description you wrote for that money.
A perfectly optimized account should make your cash productive, but it shouldn't require you to constantly monitor it to avoid triggering a penalty or a rate drop.
No, it should be working for you, not the other way around.
It's a balance of yield and peace of mind. But as we wrap up this deep dive, there is one final layer to this math that I want you to consider.
Okay.
Our source material heavily emphasizes calculating that after-tax return so you know what you were really making. But what happens to our definition of safe money when we factor in the reality of purchasing power?
You introduce the factor of inflation against your net yield.
Precisely. Let's say you do everything right. You dodge the fund trap, you verify the FDIC limits, you calculate the after-tax yield, and you are netting a solid 3% return on your cash.
Sounds good on paper.
Right. But if inflation in the broader economy is running at 4%, what is actually happening to your money? Your principal is safe, the federal government guarantees it. But in terms of what that money can actually buy in the real world, groceries, housing, a new transmission, your cash is quietly leaking value.
Yeah, it's a silent leak.
The numbers on your screen are going up, but your purchasing power is going down.
It reveals that holding cash is never a neutral position. Absolute safety from market volatility often guarantees a mathematical loss of purchasing power over time.
Which brings us all the way back to the very first step, defining the job of the money. If it's your emergency fund, you accept that slight loss of purchasing power as the insurance premium you pay to guarantee the liquidity is there when disaster strikes.
It's the cost of doing business.
Exactly. But if that cash doesn't have a specific short-term job, leaving it in a perfectly safe money market account isn't passive management. It's active depreciation.
That's a sobering thought.
It is. It's a reminder that true financial optimization isn't just about protecting the dollars you have. It's about protecting what those dollars can actually do. Something to heavily weigh the next time you find yourself captivated by a shiny APY.